Hello, and welcome to the Three Questions Podcast, where we dive deep into the world of wealth management and connect you with industry experts. I'm your host, Wayne Baxter, Senior Executive Manager at One Capital Management. Now, if you or someone close to you is a high net worth individual or a business owner looking to optimize taxes amid 2026's evolving landscape, from higher SALT caps to advanced allocations and trust strategies, stay tuned. This episode is definitely for you. Our topic: the three questions high net worth investors should ask about advanced tax planning strategies in 2026. Thank you for taking time to check us out. And if you enjoy this episode of the Three Questions Podcast, please consider liking this video and subscribing to our podcast and YouTube channels. Joining me once again on the Three Questions Podcast is Yoandre Delgado. He's a seasoned certified public accountant, now leading his own firm, Delgado CPAs. He's in Miami, Florida, has over 20 years of experience specializing in individual and corporate taxation. Yoandre helps high net worth clients navigate complex tax strategies, from estate planning to business deductions for advanced tax optimization. Today, we're exploring the three questions high net worth investors should ask about advanced tax planning strategies in 2026. Yoandre, great to see you again, my friend. Thank you for making yourself like this is the busiest time of the year. I want you to know, I honestly really appreciate you wedging us into your calendar so we can have a quick conversation here, a little bit about advanced tax planning strategies. So thank you. It's great to see you.
Thank you, Wayne, for having me again. A
Yeah, it's
pleasure to
great.
be
Well,
here.
listen, before we can get into this, I got to ask how are you enjoying life at the helm of your own CPA firm now? It's lots going on. It's a busy time of the year. So how are things going so far?
Yeah, so it's been a little bit over 2 months since I've officially started my own firm, Delgado and Associates CPAs. We're a boutique firm here in Miami and really working with clients all throughout the US and even foreign nationals as well. It's been an extremely overwhelming experience in the last 2 months, but really positively so. The amount of support that I've gotten from my fellow peers, my colleagues, you included, has been really overwhelmingly positive, and it's been really, really nice to see. So it's been a great journey so far. Hopefully, it'll continue that way.
Well, Andre, one of the great gifts of being so well connected in South Florida was getting to get to know you and meet you and collaborate with you on client cases. And really, I want to thank you for helping me. I mean, this is a mutually beneficial for sure. So, as my friends like to say, more shall be revealed as we going forward. So,
Great.
before we get to our three questions, I want to take a moment just to take a look back at 2025 from a tax planning perspective. Now, everybody talks about the one big beautiful bill, the OBBB was, it's obviously was the big headline grabber because of its extensions on tax cuts and deductions. So what I'm curious about for you was that the big deal, or was there anything else that happened in 2025 from a tax perspective that caught your attention? Any other major developments that were an eyebrow raiser for you?
Yeah, so while the OBBB was definitely the main event from a tax point of view, for high net worth individuals, it did do key things on a positive note. It provided the extension of the qualified business income deduction that is now permanent, and other Tax Cuts and Jobs Act provisions that have been extremely beneficial. But I was also paying close attention to, some of the less publicized developments. For example, the IRS has continued to kind of ramp up their enforcement capabilities, right? They have received some new funding, believe it or not. So now they're really focusing more on auditing complex partnerships, high income taxpayers, which reinforces the need for meticulous documentation, record keeping, etc. In addition to that, there's even more increasing sophistication of regulations around digital assets. This has become more prevalent among some of your clients, definitely mine. And the guidance moving beyond just regular and basic reporting is starting to tackle the complexities of decentralized finance, staking, NFTs, which obviously are a critical area for many of our clients. So some of these under the radar shifts are just as important as the headline tax changes because they dictate how we structure and really service our clients and their financial interests.
So I get a question for you just to follow up to that. And this actually, in a way, kind of segues back to a conversation you and I had with a client of mine earlier this week. And that goes with I'm sure some folks have heard of this term, some folks haven't, the term of PFICs, passive foreign investment corporations. So my question for you kind of goes back to what you talked about in terms of the enforcement.
Hmm.
So based on your experience, how closely do you believe the IRS is checking on whether or not a client owns PFICs and if they're reporting the income on them correctly? Do you think, like, is it that only a matter of those with, eight-figure portfolios? Like, what is your take on that from your perspective? Is this something that every individual, regardless if they got $100,000 portfolio with 10 ETFs in it from Canada, for example, or is it only the client that has like a $10 million portfolio that maybe has 50 PFIX, ETFs, mutual funds, segregated funds in Canada? Like, what's your
Yeah.
take on how closely is that being monitored by the IRS based on what your experience is?
Yeah, my take on that is, and my professional opinion on that is that the number of PFIX that you might have, while it is relevant for the professional fees associated with the compliance aspect of it, in my opinion and professional advice to clients would be it does not matter whether you have 10 or whether you have 50 or 150. My advice is always going to be to be forthcoming with the reporting of those PFICs. There is no, as you may or may not know, there is no failure to file penalty. The financial burden of it is really based on whatever tax there may be due from these PFICs.
From the difference between reporting and not reporting and assigning an income that you perceive it to be at ordinary income versus the rate that the IRS would perceive a PFIC to be. That would be the delta between, that's what
Right.
you're.
Yeah, and so, in my opinion, it's always going to be to be forthcoming. So we often get involved with clients before they become U.S. taxpayers, right? In planning for that change so that we properly advise them on what they need to do with those PFICs, if they do have them before it's too late, because we don't want clients to become US taxpayers and then all of a sudden realize, oh my God, I have this huge compliance obligation now that's going to cost me significant amount of dollars when really the income is not worthwhile, right? So to answer your question, what is my opinion, whether you have five or 50, it's going to be the same. You should be forthcoming
And
with
it's
that.
also not a net worth. It's not an account value issue either, in your opinion. In other words, it doesn't
Exactly.
matter if it's a $100,000 portfolio with 10 PFICs or a $5 million portfolio with 10 PFICs. It's the same.
Right, because all they want to know, I mean, at the end of the day, if you don't report, right, and they do identify that you do have PFIX, that could trigger an IRS notice and it could trigger an IRS audit. And in an IRS audit, as you may or may not know, you probably do, even when you win and the IRS does not make any changes to your tax return, you still lose because you have to end up paying professionals, and you have to pay
You're
the
paying for
professional.
the professional to help you with the audit. So you're out of pocket
Exactly.
anyway. Exactly.
Exactly. So it's better to be proactive and be forthcoming than to try to get by and risk the potential of an audit, in my opinion.
Well, I want to get to our three questions, but before we do, I just want to make one quick little point here, and that, one of the great things about the practice that we have here is that we've realized and recognized this PFIC issue, and we have developed a strategy for our clients, especially for clients who are Canadians looking to move to the US. And that, currently we look at time stamping this Zoom call. The Canadian dollar is hovering right around 73 cents US. And so the likelihood of wanting to convert to US dollars today is probably not at the highest. So the good news is that we can bring those Canadian dollars across the border, have a fully diversified portfolio, and really limit that PFIC reporting exposure. So on that note, okay, interesting insights there, Andre. Let's, and again, I think a great way to set the stage for 2026. So let's get to our three questions high net worth investors should ask about advanced planning strategies in 2026. You ready to go?
Yes, sir.
All right. Question number one. Our family owns multiple entities, including LLCs and trusts. We've seen the SALT cap rise to $40,400 under recent reforms. Is siloing this new cap possible across our family entities to maximize deductions without running afoul of the IRS rules in 2026? Andre, this one is definitely on your plate. Take it away.
Yeah, I mean, that's a fantastic question. Way to kind of kick this off.
Maybe you should start by
Um,
explaining what salt the salt is, because I bet there's folks listening going, "What is he talking about?"
yeah, it's
We didn't even
not
get to
salt.
siloing yet, but let's talk about
Yeah,
salt.
what about the pepper, right? No, so SALT stands for state and local tax. So for those of you that don't know, um, on your personal individual income tax return, you traditionally have been able to deduct uh, taxes that you pay to other states or to states in general, taxes, in addition to that, real estate taxes, sales taxes, etc. The total cap, in other words, the phase out, the total that you can deduct on your individual tax return for all of those different types of taxes is 40,400 now. The question is, how can we, for individuals that are in high tax states, and also have significant real estate taxes that they pay, for example, that in those types of situations, how can we better structure our picture, if you will, to be able to deduct those taxes to their fullest potential? And so obviously it's a fantastic question because with proper structuring, you can really take advantage of tax savings from those tax payments.
Which leads me to ask the question, about siloing. This term siloing, you need to sort of
Right.
elaborate on that one too, because I'm sure folks are, what, is he talking about grain elevators now? What do we?
Yeah, so when we talk about siloing as it pertains to, different business entities that you may have and that kind of thing, really what siloing kind of gets to is finding a way to get a full deduction for state taxes essentially by each business entity. That way, they don't all just flow through, all the taxes that are being paid are not just flowing through to the individual level. So the short answer to the question is that you can't simply just have each entity claim a separate $40,000 400 salt deduction.
For each
That's
entity. You can't do it for
right.
each entity.
You can because at the end of the day, if it's a flow-through entity like a partnership or an S corporation, for example, that's just going to be capped at the individual level anyways. So it's the same as if you're reporting it and deducting it on your individual tax return, or if you're getting K-1s that show the amount of state taxes that you're paying, right? So it's going to be limited regardless. However, there is a powerful and IRS approved strategy that achieves a better result. And it's essentially called the pass-through entity tax or PTET. Most states, not all, but most states have enacted the PTET legislation. And this essentially allows partnerships and S corps to elect to pay the state income tax at the entity level, okay, rather than the owners paying for it. So what does that mean? That means that the entity pays the tax at the entity level and then can deduct the state tax payments on the business tax returns as a business expense. So therefore, this expense does not flow through the actual, the state tax expense does not flow through to the individual directly, but it does decrease the income that the business reports. So therefore, indirectly, the individual is enjoying the benefit of being able to deduct that expense to its fullest potential without being subject to the $40,400 cap.
Hmm.
So it reduces the federal income tax indirectly by doing so.
So
And that's a great vehicle. You have to make sure obviously that you make the proper election where for the states that do allow for that. And there's other some other things to watch out for, but generally speaking, that's the answer to that
that's
question.
kind of where I was going. That was where I was going to ask you. So what are the red flags here? Like how you mentioned earlier, we were talking about PVIX and setting yourself up for setting yourself up for an IRS audit here. So I'm thinking along the same lines. What are the red flags that you as the CPA and the client should be watching for when you're going to using the siloing strategy, so you don't end up in getting that unwanted letter from the IRS.
Of course, yeah. I would say the biggest red flag is trying to do this without a legitimate structure. The IRS at the end of the day is going to look for economic substance. So some of the main things to watch out for include, the lack of business purpose. You can't just create an entity without a legitimate business purpose or investment vehicle and try to take advantage of this strategy, the structure of the business and the economic substance has to be a legitimate one. Uh, you can't just create a business entity for non-tax or just for tax-related reasons. There has to be a non-tax business reason to exist. That would be my main one. There's a couple others, for example, ignoring state-specific rules. Like I mentioned before, every state's PTT laws are different. Some have them, some don't. So you have to be especially careful with that and make sure that you're considering each state's laws. Sloppy record keeping or formalities, for example, if you start commingling funds between the entities, that can be a problem. The IRS is going to want to see separate books and records for each entity. So if you don't respect each entity's own kind of separateness of their books and records, the IRS is not going to respect that either. So you have to make sure that you're not commingling those assets. And then finally, probably I would say another red flag would be aggressive tax structures. When you're using trusts, um, especially non-grantor trusts, the rules are even more stringent. So the trust must be the one legally obligated to pay the tax and must have the income to support it. Using trust improperly to shift income and create artificial deductions is a high risk area that the IRS will scrutinize heavily for sure.
So this kind of leads back to as you were sharing this, I was thinking about one of the biggest challenges that we have, and I say you and I collectively have, is encountering the so-called do-it-yourselfer. I,
Yeah.
they're the ones who they tried this on their own are more likely to run into the crosshairs of the IRS. Would you not agree?
I would wholeheartedly agree for sure because you know for most people they that are successful and are running their businesses, it's already hard enough to, in my opinion, to keep up with the demands of running a successful business that do not involve accounting, record keeping, tax compliance rules. So imagine as an entrepreneur and a business owner, if you also add that on to your, to your shoulders, something's gonna fall through the cracks, and it most likely will be the accounting, record keeping, etc. Because that's not what makes your business tick from an operational point of view, and that's not what the entrepreneur is going to be focused on. They're going to be focused on growing the business, revenue growth, etc. So yeah, that can kind of lead to some problems if you're trying to take this on yourself.
I'm warming up to the idea that, if you're a business owner and you got like a going concern, that you should actually formulate an actual, almost like a team of, like a council team, a planning council. And I would include, obviously tax advisor, a business development person,
Mhm.
financial advisor, estate planning attorney, business attorney, risk management expert like property casualty insurance expert, commercial business insurance specialist, and have a team that knows what it is you're hoping to achieve. So as almost like acting like a council, like a round table, if you will,
Yeah,
that can act as a, a consultative team, as opposed to like you talk about siloing. When I think of siloing in my space, it's the propensity of individuals to silo all of their subject matter experts. They talk to
yeah.
one over here, they got one over here, they got one there, they got one like, and they talk to all of them, but they don't
Not
collaborate with them.
right. They don't all come to the table and really just work in a collaborative effort. Yeah.
Yeah. So I'm warming. Well, I believed in this for a long time, but I think it's something more and more that needs to be sort of put out there.
I
Don't try
agree
to.
with you. Yeah, I agree with you. And oftentimes when we get involved in discussions with our clients, we're proactive at trying to bring about those collaborative discussions because we never want to suggest something to a client from a tax planning point of view that's going to directly go against what they're trying to achieve from a different objective. So, for example, from an estate planning point of view, or succession planning, whatever it may be, we don't want to do something in the short term that's going to impact negatively the long-term objectives of the client. So we do wholeheartedly believe in that philosophy that you're explaining and aligning with. And that's something that we try to do here, frequently and consistently. You and I have had discussions together with
Yes,
clients,
more than
um,
once.
so I agree with you on that. That should definitely be happening more often.
Our topic today on the Three Questions podcast is the three questions high net worth investors should ask about advanced tax planning strategies in 2026. Joining me from Miami, Florida is Joandy Delgado, a seasoned CPA and founder of Delgado CPAs. Yawande is off and running with his own practice. And Yawande, let's get on to question number two here. Here we go. With real estate markets still volatile post 2025 and interest rates stabilizing, how can we fully utilize remedial allocations under Section 704C for our 2026 acquisitions to fairly distribute tax benefits among partners while complying with partnership rules? Again, advanced tax planning strategies. Yawandri, this is right in your wheelhouse. Take it away.
Yeah, so this is a very sophisticated topic, and I'm glad we're
And you
discussing.
some, I mean, there needs to be some sort of explaining some of these terminologies because someone
Yeah,
listening for the first time is going to say, "What did he just ask?"
I got
So
you. I'll get into it. I'll try to put it as clearly as I can. So the 704C rules are crucial for real estate partnerships. Really, at its core, Section 704C is about fairness. Essentially, when a partner contributes property, like an appreciated building, for example, to a partnership, there's a difference between its market value and its tax basis, meaning, generally speaking, how much they purchased the asset for. This is called typically a built-in gain. So the difference is the built-in gain. So Section 704C ensures that the tax consequences of that built-in gain stay with the contributing partner. There are a few ways to do this, but as you mentioned, the remedial method is often the most equitable, especially for the partners who contribute the cash and not the property. How does it work? It can get kind of complicated, but I think we'll achieve our objective here to make it simple. So the cash partners expect to get tax deductions, like depreciation based on the high market value of the property. But the partnership's actual depreciation deduction is limited to its low tax basis, which is essentially the cost, generally speaking. So it creates a shortfall for the cash partners because here they contributed, cash equal to their ownership percentage. Meanwhile, the real property contributing partner contributing the building, for example, the partnership is going to step into that basis and really only be able to claim a depreciation amount for the lower of the fair market value or the cost of or the tax basis of the building. So the remedial method remedies this. It creates a fictional depreciation deduction for the cash partners to make them whole. So to keep everything in balance, it also creates a corresponding fictional allocation of income to the contributing partner. So in a volatile market, this is critical because to attract capital for a 2026 acquisition, you need to assure your cash partners they will get the tax benefits they're essentially bargaining for. The remedial method really provides that assurance, making the deal more attractive and ensuring a fair distribution of tax bases from inception.
when, okay, I'm going to risk here getting way into the weeds, but what the heck? Let's go for it. Uh, what if say let's say the acquisition involves a family member as one of the
Mhm.
partners? Now you're getting into like, what are the tax implications from an estate planning perspective now? Because now you're involving family, right?
Yeah,
That's another layer of complexity. So maybe you could just chime in on that.
yeah, it's a great point. I mean, oftentimes, these are successful ventures, and including family it doesn't always have to be kind of like a nightmare of complexity, but it does bring challenges, right? So bringing family into a partnership adds a whole new dimension of complexity. You have to shift the focus to gift and estate tax rules now, right? So the IRS looks very closely at these transactions to ensure that they aren't just disguised gifts to avoid estate taxes. The biggest implication is valuation. So you absolutely have to make sure that you get a qualified appraisal to determine the fair market value of any property contributed and the partnership interest received. If a patriarch or senior family member contributes a property and receives a partnership interest worth less in return, the difference can potentially be deemed an immediate taxable gift to the other family partners. So furthermore, special valuation rules under Chapter 14 of the tax code, particularly Section 2701, can apply. These rules are designed to really prevent techniques where a parent, for example, freezes the value of their estate by shifting future appreciation to their children in a tax advantaged way. The solution is proactive and careful structuring. The first step, use trusts. Instead of family members owning partnership interests directly, they can be held by trust, like in intentionally defective grantor trust, IDGT. A senior family member can sell an asset to an IDGT in exchange for a promissory note. And essentially, this moves all future appreciation on that asset out of their estate. The second step, the partnership agreement must be drafted with ironclad provisions that reflect the true business arrangement.
So
So if
each property would have their own trust though, right? Is what you're saying? Every entity would have
um
their own, they would be a kind of silent, I don't want to overlap the word, but
yeah,
basically
so
held.
the interest in the partnership agreement, however the ownership of the assets is structured, but let's say in this example, a partnership is going to own an asset, right? Or various assets, depending on what the purpose of those assets are. What is the actual asset? Is it a land? Is it a building? It depends. But the overarching strategy is to make sure that instead of the individuals owning the interest in that partnership directly, the trust is the one that owns the interest in that partnership directly.
So it could
So
be multiple properties under one trust. It doesn't have to be one trust,
under
one,
one partnership.
it could be, pardon me, it could be multiple properties in one partnership. You wouldn't have
Yeah,
to have.
depending on that may or may not be a good idea, depending on the asset use, what and the asset type, right? It may not, and this is where we would consult also with the attorneys, going back to kind of your comments below before. This is where we would consult with the attorneys because then the whole asset protection and a potential liability might come into play depending on the use of each asset. What is each asset? And we need
We had a
to.
conversation about this earlier this week about a case where we were talking about setting up trusts and how you want to do asset protections under. So I,
Exactly. Right. So it really depends on a case by case basis. It may or may not be a good idea to own or have several assets under one partnership, right? But the fact that the trust needs to be the one that owns directly the partnership agreement, sorry, the partnership interest, that should be the case. And then what this demonstrates to the IRS is that it's a legitimate joint enterprise and not just an estate planning gimmick. You know, it actually looks legitimate, and if we structure it that way, then we're okay. So
well, you've just reaffirmed once again my belief that this is definitely not do-it-yourself country we're in here right now. This is
yeah.
definitely where you want to bring in an expert, and we definitely have one here with Yonder Delgado joining us. Yonder, let's get on to question number 3. Here we go. Given the permanent qualified business income or QBI deduction extensions and potential tax bracket shifts in 2026, is it time to toggle our grantor trusts, switching them on and off to maximize the 20% QBI deduction while balancing income recognition and estate tax benefits? Again, we're talking advanced planning here, and Yawandi, that is why we have you on the podcast. I will let you address this question.
So the concept of toggling a grantor trust is one of the most advanced strategies we're discussing with clients right now. It involves a delicate trade-off between income tax savings today and estate tax savings in the future, right? Or tomorrow. Um, just to give everybody a quick refresher, a grantor trust is essentially a defective, it's defective for income tax purposes. What does that mean, defective? It means that the grantor pays the tax on the trust income. So the grantor pays the tax on the individual level. This is a powerful estate planning tool because that tax payment is essentially a tax-free gift to the beneficiaries, letting the trust assets grow unburdened. You're not creating a significant tax issue down the line for your beneficiaries. Toggling off means that the grantor gives up the specific power that creates grantor trust status. So the trust then becomes a separate taxpayer, a non-grantor trust, for example. The strategy is essentially this. If the grantor's personal income is too high, okay, they may be phased out of the 20% QBI deduction. So by toggling the trust off, the business income stays within the non-grantor trust. Since that trust now is a new taxpayer with its own lower income level, it might now qualify for the full QBI deduction. So whereas if the grantor, him or herself, is a high income earner, that QBI deduction might be phased out. So by toggling it off, it can create a significant immediate income tax savings.
Is that an annual, Yoandre, is that an annual
It's
option?
no, so it's not an annual option. So once you toggle off, you lose the major estate planning benefit of the grantor paying the taxes. So the decision is kind of a balancing act, right? So you have to weigh the present value of the income tax savings against the future value of the estate tax savings from the tax-free growth. With tax brackets potentially shifting, the math on this trade-off really becomes extremely critical and timely. So it's something that you need to address on a timely basis with your advisors.
Okay, I gotta ask one more. I'm gonna again at the risk of making people's heads explode. I have to add in another layer here because I think it really should be addressed. Most clients, are more likely to have a revocable family trust,
Mhm.
but some, for whatever reason, have irrevocable.
Mhm.
So the question is, what role does that play in all of this conversation? If a client comes to you and says they got a revocable family trust versus irrevocable, uh, how does that play into this toggling and how should, families at this time of the year in 2026 align that with, what's going on, market wise
Right.
and so on?
Yeah, I mean it's a crucial distinction. This entire toggling strategy only applies to irrevocable trusts. To be clear, so to achieve the estate planning goal of removing assets from your estate, and the trust must be irrevocable. The toggle essentially is the release of a specific power. For example, the power to substitute assets. That makes a trust a grantor trust for income tax purposes. Once you release that power, it's usually a permanent decision, right? Which is what we were just discussing. The toggling off becomes permanent. You can't toggle it back on. A revocable trust, on the other hand, is always a grantor trust and is always included in your estate. There's no toggling because the grantor can change or dissolve the trust at any time. So as for the timing in 2026, it's really all about projections. If you're in a high growth scenario, for example, if the business inside the trust is thriving and you expect significant appreciation, it's often the best to keep the grantor trust status on. The long-term benefit of the grantor paying the taxes to fuel that tax-free growth will likely outweigh the short-term QBI deduction. However, if you're in a low growth or high income scenario, if the business is stable but not growing rapidly and the grantor's personal income is high enough to be phased out of the QBI deduction, that's typically the moment the model, to model toggling off. The immediate tax savings might be more valuable. So the key for 2026 is to not make a rash decision, You need to sit down with your advisory team. Like, I feel like that's the constant theme, right, of this podcast. You need to sit down with your advisory team and run multi-year projections as best you can and under various market conditions and potential tax rate scenarios. This
So
is
doing
an
almost like what we would call in my world a capital forecast.
Yes. Yeah, it's an irrevocable step. So it really does demand a deeply analytical and forward-looking approach. You can't just,
Oh,
do this.
that's right in our wheelhouse. So that's where
Exactly.
you and I, on lots of different scenarios, can collaborate going forward. That'd be
Exactly.
great.
Exactly. Yeah.
Okay, covered a lot here, but before we wrap up, so what's I know we talked about some pretty advanced tax planning here. Uh, what's one trend for this year for tax planning that U.S. families, high net worth U.S. families should be prioritizing right now? I know we covered a lot, but is there anything that we didn't talk about? And I'm sure there's tons, but is there anything that, one thing we should be thinking about for 2026 tax planning,
Yeah.
which obviously will be something you'll be working on next year this time?
I would say for our target audience, based on the theme of some of the questions we've discussed, I think the biggest trend for this year will be the need to do a strategic reset of really almost nearly every existing estate plan. So last year, as you know, when the entire conversation was dominated by, the use it or lose it frenzy with the high gift and estate tax exemption before it was scheduled to be cut in half at the end of 2025.
Which was everybody thought was going to happen, but oops, wait a
Exactly.
minute.
Exactly. So the OBBB, which was enacted last year, as we all know, completely rewrote the script. Instead of the exemption dropping, Section 70106 of the new law made a monumental change. It permanently increased the basic exclusion amount to 15 million, effective January 1st of this year for, per individual. So this, by the way, was
Like
confirmed in
30
the
million per
updated.
family, just as an FYI. We're
Yeah,
talking
30 million per husband and wife. So, or, I'm sorry, not husband and wife, right? For taxpayer and
married.
spouse.
Yeah,
Yeah,
you're
taxpayer
fine.
and spouse. So th this was also, by the way, confirmed in the updated text of the Internal Revenue Code. I could give you the section, but that's not gonna, most listeners are not gonna appreciate that. So yeah, it was confirmed by the IRS. So the emerging trend, right, has essentially shifted from a defensive sprint kind of to a long-term marathon. So the priority now is to revisit and update your entire estate plan to align with this new, more generous and permanent reality of this, 15 million higher cap. So for high net worth families, this means a couple things. One, reevaluating gifting strategies. So plans that were created based on the assumption of a much lower exemption are now likely outdated. So therefore, strategies that may have involved paying some gift tax or making complex, smaller gifts over time can most likely be simplified and made more impactful with this larger exemption. Number two, maximizing portability. So therefore, with a 15 million individual exemption, the concept of portability, the ability, which is essentially the ability for a surviving spouse to use their deceased spouse's unused exclusion, is more powerful than ever. A married couple can now potentially shield up to 30 million from estate tax. So this makes it absolutely critical for the executor of the first to die spouse's estate, let's say, to file an estate tax return to make the portability election. By the way, even if the estate is below the filing threshold, you can still do that. And then the last one would be leveraging, but and not just using it, right? So the focus, in my opinion, is no longer just on using the exemption before it disappears. It's about leveraging it. This means using 50 million to fund a powerful long-term wealth transfer vehicles like irrevocable trust, which can grow those assets completely outside of the taxable estate for generations to come. For those who didn't complete their planning in 2025, this new law provides significant breathing room, right? Luckily, now we have this expanded cap, if you will. And for those who did, it might be time to review whether those plans are still optimal. I know it sounds painful, but because I know it's a lot of effort went into finalizing those plans before it was too late. But at least we have a higher ceiling now, so you can reassess your plan.
I think it is great advice. I do have one sort of, this is, forgive me, this is the Canadian moving to the US kind of perspective of seeing how
Hmm.
things ebb and flow here a bit more than they do in Canada.
Hmm.
So the term permanent, I always must admit, this is my own take, that I take it with a grain of salt, that we use this permanent term, but, and I'm not suggesting that people not listen to you, Andre, here, because I trust him implicitly, but my concern about this whole permanent term is how permanent is permanent. In other words, envision, an election coming down the road where we have, the blue team in charge, in the White House, Senate, Congress, looking at this $30 million state exemption and going, wait a minute here, we have a bit of a tax bill on our hands here. We should maybe want to revisit this. So
Yeah.
I think this is all I'm saying is great idea, but be prepared that we may be revising a revision in the future. That would be my, I don't know, you can counter me. It's totally
No, I
okay, Andre.
mean,
We're having just you and
yeah,
me.
based on the facts, I don't know how anyone can listen to your comment and not know that to be true, right? Like if you just look at history, things change with,
Time passes and things change, to quote Don Henley.
you know, it is what it is, but for better or worse, this is what we have to plan around, right? And
As of
these
now, permanent is permanent, but until further notice.
exactly the worst case scenario, if it were to change, let's just say, and we don't know, nobody can tell, unless you have a crystal ball, right? So,
No,
but if it were
nobody
to
does.
change, even if this change would have occurred, slashing the cap in half or whatever it was going to be, even if it would have occurred, the IRS had already come out and stated that if you had planned around the previous plans, or the previous laws, that they would have honored that, right? So even so that leads me to believe, of course, this is not, I don't know this to be a fact, but if listeners want some kind of peace of mind, and let's say that um, practice remains true in the future, if you plan with the current laws, you could be somewhat optimistic that they will be that your plan will be respected and
Hmm.
kind of grandfathered into whatever changes there may be. That's not a fact, but based on kind of like the recent history, it could occur. And oh, by the way, at the end of the day, this is what we have to work with. And so why not plan around what we currently have instead of, that kind of analysis paralysis that you might get by being fearful of what might change in the future. So as you're 100% correct, what is permanent, we'll see. But this is the best we got.
Okay, one last thing, and Ariana, you've been incredibly generous with your time because I know you got up to here. So for listeners who are dealing with complex entities or trusts, what's a key first step they could take this year to audit their current setup to implement and make sure they're basically out of the IRS's crosshairs? Is there
Um,
any one thing you would suggest just as we run out the door
Absolutely.
here?
Yeah. I have a couple things that I come to mind that I would suggest if we have the time.
Yeah, you got it's on your clock. You're good.
You got to start again, keeping up with the theme. You have to start by assembling your team of advisors. That should include your estate planning attorney, your financial advisor, your CPA, and I think if all of those professionals work together in a collaborative manner, you should be able to come up with the best plan that really suits your needs and your family's needs. And the process should really, in my opinion, involve three key actions. Number one, you have to review the governing documents of your trust agreements, for example, your partnership operating agreements, or even your corporate records. read them, make sure the entities are being operated the way that they were designed to be. And if not, then make changes. Be proactive about the changes instead of reactive, right? Number two, it's usually helpful to map the entire structure. And that means creating a visual diagram that shows, for example, every entity, who owns what, the percentages, how much money and assets flow between them, and the purpose of each piece of the puzzle, each entity. And then, this exercise alone can often uncover forgotten details or structural flaws. And then finally, the third thing I would say would be to kind of model out the economics. So run financial projections to see if the structure still works to achieve your goals under current law, and just as importantly, under potential future tax law changes that may arise as they come up. So I think a proactive audit like this will identify both weaknesses to be fixed and potentially opportunities for optimization, like the strategies we've discussed today, for example. It allows you to really make thoughtful strategic decisions, in my opinion, now, rather than being forced into rushed, reactive choices down the road.
Okay, so Andre, for those who are watching here today, they can actually see your contact information. We put it right underneath right underneath you on the screen. But we got a lot of folks that are listening on Apple Podcast, Spotify. For those folks who are listening, driving in their cars on their way somewhere, maybe out for a walk, whatever, what is the best way for them to contact you? How can they reach you?
Yeah, so they can get in touch with us by calling our office number 305-929-5030. They can reach out to me directly via email, ydelgado@delgado-cpas.com. That's CPAs plural. And we'll usually our process, what it looks like, if it's a potential new client, we'll have a complimentary discussion first, kind of fact gathering and fact finding meeting, understand their picture as much as possible, and try to determine ways in which we can get involved and really provide value to the client. That's all that we're about. We want to provide value. If honestly, I've had potential clients that I've had conversations with, and I've told them, I think, the current team you have is great. They sound great. If you're satisfied with the service, there's really not much more value that I can provide. Then I don't suggest you make any change just for the sake of making a change. But it's really the majority of times that we have potential clients come our way, and we identify opportunities for us to get involved and really provide value, which at the end of the day is really our mission. Make sure that we're being impactful and providing value with our service.
Do me one favor. Can you recite that phone number again one more time? Just
Sure.
make sure I got it right.
305-929-5030.
Okay, perfect. Thank you. Andre, I want to thank you again for joining us today. Yoando Delgado joined us today from Miami, Florida. He is a certified public accountant and founder of Delgado and Associates CPAs. Thank you very much, Andre. We'll see you soon.
Thank you, Wayne.
I look forward to bringing you the Three Questions podcast, and I hope you find them educational and informative. Please consider liking this video and subscribing to our podcast and YouTube channels. And to receive a notification of when our latest episode has been posted, please click on the notifications bell. Lastly, to schedule an online Zoom consultation with me to discuss your wealth management needs, please click on the link in the description box below, www.onecapital.com/meet with Wayne. Thank you, and we will see you soon.